Hello guys, how you doing? How is your trading week going? I hope it's fantastic. I hope it's great. In this video, what we're going to be talking about is candlesticks. What are candlesticks? What makes up the candlesticks? How can candlesticks help you determine the movement in the market, or what's going to happen next in the market? If you're new to the channel, my name is Lawrence. You can call me Black. Be sure to subscribe to the channel so that you won't miss out on future content. So with that, let's dive right into it. So what is a candlestick? Well, a candlestick is just the graphical representation of price movement within a specific period of time, right? So let's say prices were moving from down here to somewhere around here, right? Let's say within 4 hours, right? Within 4 hours. So what will happen is that the candlestick formed will be something like this. Of course, candlesticks have a little bit of wicks, depending on the price movement, but the candlestick that will be formed will be something like this. That means this candlestick represented the price movement from down here, all the way to up here, within the specific time period. So I used an example of 4 hours, but then if maybe this happened within, I don't know, 1 day, this will be the graphical representation of this price movement within the whole day. If this happened within 1 hour, this will be the graphical representation of this price movement within the hour. Same applies if it was 15 minutes, 1 minute, seconds, right? Whatever the price range is, this graphical representation represents its movement in this specific time period, right? Now, a candlestick is actually made up of 4 major components, right? So for a candlestick to actually make sense, it actually has 4 items. It has 4 specific things that actually bring it to life, or that actually makes us understand what the candlestick is saying, right? So we have this up here. This is called the high, okay? This is called the high. This up here, this is called the high, right? And then down here, the lowest point, we have the low, right? So we have the high, we have the low, right? Now, depending on the type of candlestick that is, for instance, this one right here, this is the price movement, right? So this was a bullish movement. So that means this was the open down here, where the prices started its movement. This will be the open. And then where the prices will close, that will be the close, or where the candlestick will actually end its day, right? It will end its move. That will be its close. So right here. So these 4 things, while you're actually reading a candlestick, these 4 things that are what actually makes a candlestick. This is what actually makes up a candlestick: the high, the low, the open, and the close. Well, of course, this is a bullish candlestick. Now, let's look at a graphical representation of a bearish movement in the market, or a bearish candlestick, as I might say. So let's put it in perspective right here. That was a bullish candlestick, so this right here will be a bearish, right? If this video is being of help to you guys, you can help me out by hitting that like button. Now, these 2 things don't change in regardless if it's a bullish candlestick or if it's a bearish candlestick. The high and the low stay the same regardless the type of candlestick that is. So even if it's a bullish candlestick, even if it's a bearish candlestick, this high and low never change. What actually changes is the open and close. Okay. This will be an open. And then this one right here will be the close. Oh, excuse me. This will be the close. Right? Now, obviously, this will be a bearish candlestick. Right? This will be a bearish candlestick. Excuse me. Okay. Right. So looking at this bearish candlestick, this is the bearish, as I was saying, this is the bearish candlestick, this is a bullish candlestick. So the difference is its open price and its close price, right? So a bullish candlestick opens low and closes high because prices are coming from a low price range going to a higher price range. That means, for instance, if we look at this market price here, so let's put a resistance, right? So you can see here, prices in this bullish candlestick were coming from 92.47 to 94.71. But in this bearish candlestick, prices were coming from 94.71 to 92.47, right? So the difference is in its open and close price. That's how you determine if this is a bearish candlestick or if it's a bullish candlestick. So for others, they like to mix it up with different colors. As for me, my bullish candlesticks are white and my bearish candlesticks are blue. So just by looking at the color of the candlestick, it helps me realize what type of candlestick this is. Easy, right? Others don't like to put color. They say it brings out emotions. For me, it doesn't. So it actually depends on the type of person you are. You just have to look at the open and close, and then that will actually help you understand what type of candlestick this is, right? If it's a bullish candlestick or if it's a bearish candlestick. Now, how do candlesticks actually help you improve in your trading, right? What do candlesticks actually have that can actually make you understand what's going on in the market? Well, now with candlesticks, as I just told you, it represents price movement, right? Now in the market, you're actually trading the price movement. Prices are moving from one place to another and you're trying to capture that move, right? Now, remember that these candlesticks of different sizes, you can find some candlesticks are large like this. Maybe some is large, not that large, you know. They move in ranges, so they're actually different types of candlesticks, right? So you can find some are large, some are huge, especially the ones that are actually fundamentally influenced. Like those candlesticks are crazy large, right? So something like this, right? So there are different ranges of candlesticks within the market because there are different types of players in the market, obviously. Now, okay. Let me also put some sort of lines because candlesticks actually have an open and close, as I just showed you up there, right? So bear with me, bear with me. So these candlesticks, right? What I'm trying to explain here is that each candlestick is unique. Note if, for instance, the past candlestick, for instance, you're in the market and maybe the last 4-hour candlestick was maybe very strong, right? And then this candlestick, this hour candlestick is weak. What you have to read is not the previous candlestick, but the current candlestick, because that is what is actually showing you what's really going on in the market at that current moment, because the decision you're going to make is based off that current moment, not what happened 4 hours ago, not what happened 3 hours ago, not what happened yesterday. It's what is happening right now. That is why you're told prices are evolving, prices are moving, are always changing, prices are always changing. That is why I'll also create another video that will actually show you why price action is the best trading strategy out there that there is, right? Okay, I'm done drawing. So look at this. What I'm trying to explain here is that there are variety size of candlesticks, right? From this large candlestick, you know, sizes vary, right? But anyways, from the largest candlestick to the smallest candlestick that you can see in the charts, these candlesticks actually represent something, right? As you can see, if a candlestick is that large, right, what it actually means is that the larger the candlestick, the larger the momentum. Okay, so the larger the candlestick, the larger the momentum. The smaller the candlestick, the smaller the momentum. Okay, now as you can see here, so if it's in the market, you're somewhere in the market and then you see this large candlestick like this, you just understand that, okay, right now this market has a large crazy momentum. And what does a large momentum mean? It means that there are a lot of people that have actually made this transaction. So let's, for instance, say prices are in a resistance zone. Let's assume this is a resistance. Here it's a support, right? And then prices were actually moving like this, pop, 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 and then they reached here. Once they reached here, they gave us something maybe like this, a large, let's say, bearish candlestick, right? A large candlestick. And so they give us a large, crazy bearish candlestick. And the bullish candlesticks were maybe something like this. Let's assume maybe the previous candlestick was a bullish candlestick and it was that size, right? Now, what this means, I'm not going to draw that line. So what this means is that this was a bullish candlestick. And then right now, the bearish candlestick came up this crazy large after hitting that resistance. So what it actually means is that the people or the large institutional traders, whatever, people call them large sharks, whatever you want to call them, but people have actually taken this bearish trade. A lot of people have actually taken this trade more than the people that are participating in this bullish move. So that means if people see this candlestick form, even more people will be influenced to take this trade again because they see the momentum is now bearish. It shows that a lot of people are actually trading this candlestick going short. A lot of people are actually selling. A lot of people are actually selling. So that means a lot of people will actually add on more sell orders. And if you just don't know this, the market is moved by money. The more people that make this transaction, the more people that take this trade, the more movement it will have in the market. So if people see a lot of people have taken this bearish trade, more people will actually add on more money in this trade, and the trade will actually keep on falling lower, right? So that's how the market plays out. This candlestick formation here will actually give the indication of people on what to do. But for instance, here, people couldn't take this buy trade because it was this size, it was a small candlestick. That means few people are actually taking this trade. Now, if you're in a cycle and you see more people are actually doing this thing, it will be crazy for you to do the opposite. You'll actually be going against the big sharks, against the large traders, and that will actually make you lose money. So just by understanding the candlestick momentum in the market, it will help you understand what to actually do in the market by knowing where most traders are placing their bets on or are placing their trades on, right? So the larger the candlesticks, the larger the momentum, that means more people are actually taking trades in that particular direction. So this is a great concept that if you're understanding it, it will be of great use to you, and therefore you should actually grasp it. The larger the candlestick, the larger the momentum. The smaller the candlestick, the smaller the momentum. Always trade where there's momentum. In the market, you want to make money. So trading in a place where there is no momentum, where there is no more, as my nigga Sako likes to say it, where there is no more, then just know that it's gone. It's gone. You shouldn't be in that trade. You should always trade with more, with momentum, guys, with momentum, right? Always trade where there's momentum. So that's what I'd like to talk about candlestick momentum, right? Now, the last thing that I'd like to talk about candlesticks is that within a candlestick, right? So for instance, let's assume this is a monthly candlestick. This is the monthly candlestick. So, excuse me. So let's assume this is a monthly candlestick. So what it actually means is that within this monthly candlestick, in the month, it forms one monthly candlestick. Obviously, we know that in a month, there's only one monthly candlestick. But within this one monthly candlestick, what makes it up? 1 month is made up of 4 trading weeks. So that means within this one trading month, it can be made up of what? It will be made up of even smaller weekly candlesticks. So that means inside this one single monthly candlestick, inside this single monthly candlestick, it's made up of even smaller weekly candlesticks, smaller weekly 4 candlesticks, because the month is actually made up of, 4 candlesticks, right? 4 weeks, 4 trading weeks. So that means it's actually made up of 4 weekly candlesticks, right? So in trading, multiple timeframes actually co-depend on each other, right? So for instance, if you see a daily candlestick, that means that daily candlestick is made up of 24 hours of 1 hour candlestick. It's made up of 6 hours of 4 hours candlestick. It's made up of 4 8-hour candlesticks. So if you see one candlestick, just know that it's made up of even smaller candlesticks within the lower time frames. So for instance, in this particular time frame, okay, we say this is the monthly candlestick, and then this one here is the weekly candlesticks, right? So that means for this one monthly candlestick to form, it actually had to go through this move all the way up here, right? And then prices fell down here, and then before they actually went up there, right? So that means prices, okay, this is a bullish candlestick, this is a bullish candlestick, this one here is a bearish candlestick. Let me change its color so that maybe it will look different, right? Let me make it white. Okay, let's make it different like that. So that means this is a bullish candlestick, this is a bearish candlestick, and then this is a bullish candlestick. But what happened in this monthly candlestick is that it opened here, right? It opened here, and then it did not close until prices reached up here. That means within this one monthly candlestick, just for you, if you're looking at it from the monthly perspective, you'll just see that prices went up. But then in reality is that it went through all this. It went through all this move. It was a week with small momentum, came a week with large momentum, a reversal week, and then prices still came back up here and closed up here. If you look at it from a monthly perspective, you'll see like prices just pushed up, but then in reality, this is what happened over the weeks. And then if you go even lower in the daily timeframes, you'll find that one weekly candlestick is made up of 5 candlesticks, 5 daily candlesticks, right? So that means these 4 candlesticks, these 4 weekly candlesticks are made up of 20 daily candlesticks. And those 20 daily candlesticks are what make up this month. So that means within each candlestick are even smaller candlesticks that make it up. So that means each time frame is dependent of each other. That means the monthly depends on the 1 hour, the 4 hours, the daily, the weekly, make it up, make it what it is. And also the monthly candlestick or the monthly indication or the monthly direction like this. For instance, if you're doing analysis, you always start from the bigger time frames like the monthly. So that means if you see the monthly candlestick like this, it actually gives you perspective of what is going to likely happen in the market. So for instance, if the monthly is this crazy bullish candlestick like this, you obviously understand that the prices are most likely to keep on pushing higher because it has a very strong bullish momentum. So that means most of the traders are going bullish, are buying. So that means if you go in the lower time frames, it will be wise for you to look for more bullish confirmations or for more bullish trades. But still, those bullish, small bullish trades are what make up this monthly candlestick. So each time frame is codependent of each other. That's the beauty of candlesticks. So that's it for today's, guys. If this if this video has been of help to you, be sure to give us a quick like, subscribe so that you won't miss out on future content, and hit that bell notification so that you'll be notified whenever we release future content. Until next time, guys, this was Black speaking. Peace and love.